All right, why don't you go ahead and kick us off, Ken?
Okay, well, we'd like to welcome everybody here on behalf of the Better Investing Mid-Michigan chapter and Manifest Investing. We hope to run this program 6, 7, 8 times a year. It will not be a monthly program, but we will inform our folks that are on our reminder list for the roundtable. We will let you know when it's going to be happening. We send that email out to about 800 different people, plus all of the people in mid-Michigan. If your chapter would like to forward that email, feel free. Feel free to forward those emails on the roundtable or on this program to anybody that you'd like to forward them to. That invitation is good for anyone to use, member or non-member. We're just going to chat this evening. Tonight's program is called Selling Better, Preserving Capital and Capital Gains. We presented this particular class at the Better Investing National Convention last May, and it met with a lot of good comments. A lot of people were intrigued with some of the ideas. This is a work in progress, so the class tonight will be different than what we did in May because we've begun to experiment with our ideas, and as different things work and as different things don't work, we're gradually making small changes. But here's our ideas to this point about how we think we can go about selling better. Before we get much further, let's get the legal stuff out of the way. Mark, there it is. This is an educational demonstration. We are going to be discussing some stocks this evening, some specific named stocks. We're not making any recommendations as to buy or especially as to sell. You need to do your own homework and draw your own conclusions before you make those decisions. We might actually hold some of these securities in our own portfolios, and we'll try to remember to tell you if in fact we do, but we don't always get to that place with some of the names as we go through them. One more click if you would, Mark. And I'm going to start off the session by making a point that needs to be listened to very, very carefully. We don't want to give the impression that we're changing anything in Better Investing philosophy. We're committed to the beliefs that have been long-standing in the Better Investing community. We believe that there are absolutely good foundation reasons why you sell a stock, and we don't want to fool or mess with any of those particular reasons, but we are exploring a concept which might help us do even better at this selling game than we have been doing at the past. We still believe that the reasons to sell a stock are simple. You need the money. The quality in the stock is degrading. Sometimes people talk about the wheels falling off the company. That's what we mean by quality degradation. Or the biggest reason you sell a lot of times is to make your portfolio better. That all being said, we think that we would like to find some triggers that would help us preserve capital in the early stages of an investment and help us preserve capital appreciation for stocks that we've watched make a lot of money. We've noticed as we visit clubs and chapters throughout the country that a real common theme among a lot of the people is that they've followed a stock all the way up to record highs, and then they've turned around and followed that stock all the way back down to almost nothing. And there's never been a trigger, there's never been something to say, stop for a moment and decide, should you be selling all or part of a holding that has made a terrific gain or a terrific loss. These are the kind of triggers we're going to look for, and if we can find a couple of them, then we think that there are more tools that we can add to our toolbox. There's some things we can pull out of our tool belt and use to help us do better at this investing game that we're all interested in.
Yeah, and
Mark, why don't you go on ahead, Mark. Yeah, just jump in. We can't see each other, folks, so we don't get the visual cues we normally do. So forgive us if we step on each other just a little bit, but go ahead, Mark.
Just pretend your hands are on the steering wheel and you're looking straight ahead and you're still arguing with me.
Okay.
I guess the thing I'd like to point out is we had the question in Cincinnati from the audience, and we've both received emails from people wondering about, are you messing with, philosophy or method or whatever. And I think one of the more exciting things that as we sat and dragged this thing across the coals that we began discovering is we're actually reinforcing some stuff that's been around. You're going to see that with the rule of 5, but my point is we're really just talking about doing something that's already in the acumen or the methodology already. And the results so far, they're obviously, as Ken said, it's a work in progress. We don't know where this is going to end up, but the stuff that we have kept track of in the model portfolios and the tracking portfolios that we do take care of at many of our joint presentations is very, very promising. And many people, there's just a couple comments that are very typical at the bottom of this page that people are looking for this sort of thing to help. And again, I have to attribute the quote on that cover slide to Ken. One day we're sitting around talking about this, and we all know about the portfolio management stuff where we're trying to use the portfolio centered decision type stuff that we're going to cover here tonight. But this notion of don't just protect the capital gains, but also protect the capital right at the get-go. So that's what we're going to dig into tonight at this first session. One of the things that we'll run into, we thought we'd just take a quick time out, is we do think of stocks differently, a lot like you might think of your children or your grandchildren differently. That doesn't mean anyone's better than the other, just different. And we think the stocks also fit that bill, depending on whether you regard a stock as a core holding or a non-core holding. Again, non-core would be something unusual or speculative. A special situation is how you hear some other people refer to it. Well, we think you ought to have different return objectives, different rewards in mind when you go after one of those companies versus a company like a McDonald's or a Procter & Gamble or, these core high quality companies. Just different expectations, different buying points, different selling points, and that's a completely natural and logical thing. So again, we want to make sure that we're always simplifying, make the decisions from a total portfolio perspective, and the thing that Ken will be talking about here with Rule 1. And again, just this notion of treat core holdings, think about them differently than non-core holdings. And one of our major rules is going to be to think more about selling if core holdings drop down around money market rates, which right now are pretty close to zero. Non-core, as you'll see with the example tonight, the market average right now is about 7%. If you thought of stacking up about 2,000 stock selection guides and said, what's the average of those stock selection guides? Their Section 5 projected annual return would be about 7%. So again, if it's a non-core holding and we have higher expectations, we're probably going to buy it higher and sell it higher. But
Mark, I'd like to add something to that non-core idea also. I think that a place for non-core holdings also are holdings in your portfolio that the SSG does not do a real good job of evaluating. I think sometimes for certain companies that we purchase, people are loath to describe them as speculative, but the SSG does not really handle the evaluation for that company. The name Amazon, for example, comes to mind. The name Facebook for a long time was a very difficult stock to analyze on a stock selection guide. NVIDIA is another one that has a hard time putting a good stock selection guide together. ExxonMobil, BP Petroleum, those are other examples of companies that the SSG is very difficult to analyze. So I might put those under non-core holdings as well, even though I think I might refer to them as slightly speculative to very speculative. If you don't like that term, then talk about whether or not you can actually do a good SSG on it. And if you can't, then probably you're looking at a non-core holding. It's okay to have that in your portfolio. Nicholson suggested that 10, 15, 20% of your portfolio could be made up of non-traditional holdings. That's what he called them. But this non-core idea, it's good to have them in a mature portfolio if you're at least an intermediate or experienced investor, and they make the whole hobby of investing. I don't know if it's a hobby for a lot of us, but they make the whole process a little bit more enjoyable if sometimes you can play off the reservation, and if you can look at stocks that are a little friskier and act a little bit differently than the 75 or 80 or 85% of the stocks that we tend to hold, which are the good old-fashioned up, straight, and parallel type.
Yeah, and we see Hugh McManus do some fairly special, and I'm using that word lovingly as a term of endearment. That short track record is a reference to companies that are very early in their life cycle as a company, and that is the type of company that the SSG struggles with in some cases fairly mightily, and it's also the type of company that drives Morningstar and Value Line crazy also because they want more information. And that leads us to that core definition of a high-quality company that's survived at least one recession. A company that's gone into and come out of a recession, at least you know how they're going to behave. Many times we'll be dealing with an early-stage company that might not even survive the next recession when it comes. So that's kind of the break point or a defining point as we think about these type of companies. So let's go ahead and just make a quick reinforcement. I'll take this one, Ken, if you don't mind. We just want to just reinforce that we're not messing with anything here. We're talking about maintaining the selling rules that we've always had. And again, it's just this is the one slide that we seem to always have in our portfolio design and management discussions. Reason number one is you need the money. You pick the companies that have the lower return forecasts in your portfolio. It's the same thing we do with our dashboards when we sort them by their par or their return forecast, and we start challenging, put the ones on the hot seat that have the lowest return forecast. Same thing. That's how you would generate proceeds from sale from a portfolio. The other reason, as Ken mentioned, if the wheels start coming off or profitability starts to suffer, growth starts to slow, a company becomes cyclical or perhaps well into the mature stage, quality can be in decline. But the one that we'll talk about here for a few minutes is that reason number three. You're simply trying to make the portfolio better. You're trying to have enough return forecast. You're trying to have enough quality, and the same thing with enough growth. And basically keeping things within target ranges and being very prudent about it. And this is a subject that we explored 13 years ago on the pages of Better Investing. Why don't you go ahead and talk about this one, Ken?
We went back to the investors' manuals that were given out to members in the mid-'80s. We felt that manual, the one that you see in the upper left-hand corner there, that manual probably reflects Mr. Nicholson at his best. It reflects the clear, straightforward thinking that put the investment club movement together, and then it sets some rules that are pretty easy to understand and much more sophisticated than one might be led to believe when they characterize Better Investing as nothing more than buy and hold. It's actually a much more sophisticated a discipline than that. And in the 1984 Investor's Manual, I happen to have a first edition at my home here. It says Rule 1 will probably account for 90% of your sell transactions. And when I read that, I thought to myself, well, that's a pretty large percentage of attributing everything to this one thing. So I searched for Rule 1 real quickly, found it without too much trouble, and Rule 1 says, sell because an issue of equal quality offers more gain prospects on the upside and apparently less risk on the downside. So it's trading one stock for another. I happen to think that when this was written, Mr. Nicholson probably was looking at the second rule that Mark just covered and the third rule that Mark just covered, and kind of clumping them all together. You need the money was maybe the other 10% of the formula, 10% of when you would sell. But to make the portfolio better obviously includes replacing companies where the quality is in decline, where the wheels are falling off. It also means if you can find a company that's doing better than one of the ones you have, then you want to consider making that trade, as long as you're not messing with this notion of quality, which kind of just permeated everything that Nicholson wrote. This concept of looking for high quality companies with predictable earnings was something that he just said was the bedrock of everything we do. And I think most of us here this evening understand how important that happens to be. Mark, why don't you speak to why you decided to put Panera Bread in the middle of this slide?
Well, this is one of those exceptions, and it falls somewhere in that 10 or 20%. And plus, you also can see how we keep track of, what the company was, when it was selected, by whom. You can see the holding period, and there's probably several Panera Bread shareholders in this audience. And if you are, you know that the sales transaction closed recently. Panera just disappeared from Value Line coverage in the most recent update. But again, we keep track of what you paid for the price of the stock at the time of the decision. Then during the holding period, in the case of the roundtable tracking portfolio, we invested $1,000 into each one of those decisions, and you can see we're basically comparing versus, how did that $1,000 investment do versus how it would have done if we're simply invested in the market, and that's what we mean by that relative return. We'll cover that in greater detail, but those of you in the audience that benefited from Panera Bread, including my wife who's sitting across the room here, as a shareholder, she had a pretty good time with Panera Bread. And that's a reason to sell a stock that is certainly worthy of festivity and celebration.
Well, a great reason to sell is to look for a better quality stock. This list that we've put together right here should be of no surprise to anybody. These are the kind of things we check, and if we're going to trade one stock for another, then these are the kind of things that we focus on when we're looking for better quality. Straighter lines, increasing profit margins and or return on equity, acceptable debt, possible PE expansion. And the replacement stock needs to offer a greater total return. Remember that we're using crayons, however, to create these stock selection guides. And I don't care what the stock, if my stock selection guide said 8% and another one said 10%, I don't think that's a suitable increase, especially since there's plus or minus numbers attached to all these returns. I don't think that's a suitable increase to make a trade. But if I find an equally high quality company for one that I own, or even higher quality, if I find one like that, and the one that I own says 8% par, and the one that I'm looking for says 15% par, and I'm in a non-core holding, I don't hesitate to make that trade. It sounds like I trade 3 or 4 or 5 times a week, and in fact, I'm lucky if I trade 3 or 4 or 5 times a year. But I'm always open to these kind of trades. I think that Nicholson put it very succinctly in a small article that he wrote outside of some of these books when he said, you sell when you can make the portfolio better. You sell when an opportunity comes along for you to improve the quality of the entire portfolio. That's the crux of traditional selling discipline, and Mark and I have no intention of focusing on changing any of those basic tenets.
Yeah, and I think just to reinforce, I don't know what rule number he called it, but he talked about also being very, very careful, especially after a bull market's been running for a while. to not take a high quality stock and replace it with a lower quality stock. It's a pathway to disaster. Our investment club in Chicago proved this a couple of times. We learned our lesson. I mean, I can remember the night that I made the motion to sell Intel and replace it with a Canadian battery technology company. That you know, you're probably looking at a company in the top quintile of all companies, replacing it with one with a very sketchy and skeptical outlook, and that didn't work out very well for us. And again, his warning was just be careful, especially in market conditions like we have today, to resist the urge to replace a high quality stock and replace it with a lower quality stock just to gain a few percentage points of return, because that can be a fairly dangerous thing. And again, you're violating the rule if you do that, at least not in moderation. If you're buying lower quality stocks and throwing higher quality stocks out of the portfolio, you're by definition probably not making the portfolio better.
Mark, we're getting a good comment or question from Bonnie, and she says, how about the moat idea? Would you have to have a moat, or would you insist on a bigger moat? And I'll take a stab at it to begin with, and then let you weigh in on it as well. Bonnie, this moat idea refers to how immune the company is from competition, how hard it would be for another company to open up their doors and immediately begin competing with the company that you're looking at. And I think that that's a function of quality, especially a function of quality the way it was measured by Graham, or the way it was measured by Nicholson, or the way that it's measured in manifest investing. When we measure quality in manifest investing, we look at relative performance as far as profit margins, and we look at relative performance as far as net sales. And when we're talking about those two items, I think we're in fact describing how strong or how weak the moat happens to be. Because if the company is being challenged, then its margins probably are going to move down, and that's going to affect their financial stability and affect their quality. So I do think that that's an important concept, this idea of moat. But I think it's already built into this idea of quality. Butch would like us to give a good way to actually define quality, Mark, and that's a real nice softball, so I'll throw it right to you, okay?
Well, first of all, I would agree. I think you'd find a very high correlation between relative quality levels. There are exceptions. There's exceptions to everything, but a high quality company is generally going to be a company with a probability of a wider moat, as Ken said, a resistance to competitive threats, that sort of thing. Nicholson and Benjamin Graham defined quality the same way, and it's the same way that manifest investing does. We center in on four characteristics: the financial strength of the company, the consistency of earnings, the earnings predictability that you know as straight blue lines on the visual analysis that you do for a company. And then we care a great deal about the growth prospects and the profitability prospects for any company versus its competitors or peers. Those four elements are what make that up. I believe that in at least two of those, if not more than that, three of those elements of quality at manifest investing have moat characteristics, or the characteristics of moat would actually impact those numbers. So they are pretty closely aligned. I spent an afternoon with Pat Dorsey years ago at Morningstar. We were chugging over the quality rankings versus their moats, and he agreed there is very high correlation, and they align pretty well, again with a few exceptions, but quality and moat are very closely related. All right, let's go ahead and shift gears into defining and make sure everybody knows what we're talking about. When we talk about this notion of excess or relative returns, we're just basically answering the question, does the position that you bought or the portfolio you're managing beat the market? And we basically compare the same way that the Bivio or the investment club accounting software does this, keeping track of the rate of return of the portfolio, and then offering you benchmark indices that you can compare versus. In the case of the roundtable, the internal rate of return is about 13.5% now, investing those same $1,000 ideas into the Wilshire 5000 over the same time frame would generate about a 10% return. So we're looking at a 3.5% beat or outperformance to the market, and that's actually a huge number. We're not going to go into it now. We'll probably do it at a future session, one of our future turnout moments. But that is a huge number to beat the market by 3.5%. It's certainly a yawn-free zone, so you can watch for future discussions on that. All right. Do you want me to take this one, Ken, or do you want to go for it?
Yeah, go on, continue, Mark. Yeah.
All right. Again, I just want to reinforce this is a work in progress. We're not talking about messing with anything. As Ken has described, rule one, really that does come down to the way that we use our dashboards in the context of portfolio-centered decisions. It's not about the individual company so much as what the portfolio adds up to. Just a reminder that you can have quality degradation. We'll be looking at a case of that tonight. And again, based on the return forecast, if a company dips down into the red ink when it comes to the return forecast, whether it's core or non-core, that can be reason enough to sell. Those are the traditional things that we've looked at, both from an individual stock standpoint and from an overall portfolio-centered perspective. And what we're going to talk about here tonight is just consider the notion of adding this relative return that we just defined as an alert or a trigger for sell. And again, we have been doing this now in a number of places, including the roundtable, our monthly webcast program that we put on, monthly stock selections that we make, and then the fave five thing that we do for Fridays, the tracking portfolio for that. We've been implementing this type of a notion of using the relative return. If a stock drops a certain amount, we're going to talk about the subject in detail, but we have been doing it in these three different portfolios with some fairly intriguing, I would even dare to say compelling results so far. I'll go ahead and take this one too, Ken. I mean, again, as I said a few minutes ago, we think we're not violating or doing anything different outside the book. We're sticking to the book. This is the rule of five as we understand it, that if we do a stock study and come up with a stock that we think is fairly attractive with a decent amount of growth, here's the quote from David L. Babson. This is the rule of five. 1 out of 5 stocks will disappoint you no matter how well or how strenuously or diligently you perform your study. About 3 out of 5 or 60% will do pretty much what you expect it to do. And then there's always going to be that one stock, that one universal display, ticker symbol OLED, where Ken and I in the audience picked it a few years ago, and I think it's gone up about 800% in 2 years. Sometimes they get extraordinary, and those can actually carry a whole lot of strength for a portfolio. So this rule of five is just this notion of no matter how well or how hard you study, things happen. Things go wrong. Things are unexpected. Sometimes it can be just the herd misbehaving. And we went back and looked at portfolios. How often does that seem to happen? And we're seeing about that type of frequency for the roundtable. You know, maybe 8. Keep in mind that we select 4 or 5 stocks every month. So we're talking about 50 to 60 stocks every year. And we have a half dozen, maybe 8, maybe 10 per year that quote, unquote, misbehave and just behave in ways that we didn't expect to happen. Anything you'd like to add to this, Ken?
No, but I think it's fascinating, Mark, that Babson was writing back in 1960. I mean, that's quite a few years ago, and he was doing it without a lot of tools, but this was more intuition than anything else, and yet the academics have seized on this paragraph and tested it a number of different times in a number of different pretty high-class business schools, and they've decided that Babson, in fact, probably was onto something, that this type of division seems to occur with people that are reasonably good investors, whether they're managing a portfolio as an amateur, but they really put their mind to it, or they're managing money professionally. This 1 out of 5 not doing very well, and this 1 out of 5 doing extraordinarily seems to hold pretty much true as you study the different portfolios put together by lots of different kind of stock pickers.
Yeah, so the question for tonight and for the entire body of work that we're doing in this area is, what if? What if you could catch that 20% as it's still falling apart or beginning to disappoint? And we think it's possible. And here's basically the premise of what we're talking about here tonight uh, for this possible addition. And it goes back to the work done by William J. O'Neill. Some of you know him as the originator, the creator of Investors Business Daily. They have their own set of rules, and they talk about this notion of carefully averaging up and without any emotion or remorse or anything else. If you buy a stock at $100 and it drops down to 93 or $92, a decline of 7 or 8%, you just sell. You walk away and you go do something else. Go find something else. And as we think about that, that is a kind of a bit of a trading flavor to it. We think that the 8% would cause a whole lot of transactions that we probably wouldn't care for. We think we're investing, not trading, and that again, that 8% would probably lead to some stuff we wouldn't want to do. And then this other notion of, well, what about the what's going on in the whole stock market, or for that matter, the industry that the company belongs to? If the market drops 10% and your stock only drops 8%, and everything still looks really good, should this be a sell? And we don't think it should. We think as investors, companies, as we said, these high quality companies, this type of thing happens. Companies can move in fits and starts, and we just have to be accepting of that concept. So again, we do want to keep this simple. So what we do in those tracking portfolios that we mentioned just a few minutes ago, including the roundtable, we track the actual relative return during that first year after we bring the idea and place it in the tracking portfolio, and we will place it on the hot seat going forward when the relative return reaches minus 20. We really want to focus in on the stuff that's less than a year old. That's another aspect that we are juggling and trying to decide exactly how we want to handle. But for right now, in that first year, we want to analyze any company that begins to lag the market by 20% or more. And take it from there.
And remember, folks,
go ahead, Ken.
This is a work in progress. So we're not certain about this negative 20%. Maybe a better trigger is negative 15. Maybe a better trigger is negative 25. We're still experimenting. We're seeing what negative 20 does. And maybe a year is too short. Maybe it should be 18 months. Maybe it should only be 10 months. But it's a work in progress, and it's not going to be something that we're going to quickly put into hard and fast rules for real money. Notice that we're testing it right now on portfolios that we show to the public. We're testing it on places where you can check out whether or not what we're doing is being successful or not, but we're not sure we have the actual numbers down that are going to guide us to the correct trigger. We just know that we have a gut feeling that there is such a trigger based on relative return, and that's something that's intriguing to us because we haven't found anybody else in the market that is basing selling decisions, either short-term or long-term, on relative return and on quality.
Right, and again, the minus 20, you could also make an argument. In fact, we did this. It gave us headaches. We went through a little bit of Motrin and Excedrin, but we actually said, well, maybe that minus 20 should be conditioned based on whether it's a core or non-core company. And we said, well, maybe we could factor it. And I know some of you number junkies out there in the crowd tonight, you're sitting there thinking, yeah, you could probably come up with an algorithm that would do that. At the end of the day, we came back to this notion of keep it really simple, pick a number somewhere in the mid-range and see how it behaves. And so far, that's been a pretty cool decision based on the results. Let's take a look at one of the case studies that really inspired this. And the company was Iconics Brands. This was one of the first ones where this kind of came home to roost for us. We had talked about this during the roundtable sessions. I made the presentation on Iconics back in April 2015, and it was an awesome presentation. It's a stock selection guide has never been done better, or more diligently, more prudently. I covered all the bases. Are you agreeing with all this, Ken, or are you just sitting there shaking your head again?
I'm agreeing with everything you're saying. I'm reading a comment from George, and as soon as I can get a break point here, I'm going to insert the comment into the discussion, Mark, okay?
Oh, okay. Well, anyhow, this is one of those things. I couldn't imagine anything going wrong, while at the same time, I would have regarded it as a non-core. And in fact, I said that during the presentation. You can go back and listen. I said, I'm going to have this thing on a very short leash because it's in that retail area where fads can be very elusive. And well, what actually happened was just a few months later, it had lost its 20%, and we sold it and got out of Dodge. And you know, a lot of times, you know how you on investment club or you as individual investors will buy that company. I loved it at 1,000. I guess I must love it a whole lot more at 800, right? Because the price has gone down 20%. Well, again, be careful about averaging down into situations, especially if it's not the highest quality company, because you know, even though you're down 20%, you can continue to lose. And lo and behold, it continued to drop. And in fact, it's actually dropped again here in the last month and is now worth $162 of the original $1,000. So by getting out at 800, we have literally saved, at least at this point in time, roughly $650. So that's what we mean by preserving capital. And this is one of those that I think qualifies for the rule of five. I think my presentation was decent, not without risk, but it just didn't work out very well. And I don't know, over the years, probably a few of you out there can also relate to holding on to that stock that just keeps hammering away and continuing lower, and it just is just not a pleasant situation. So this type of thinking, literally, we actually have referred to it as a timeout, the same type of timeout that you might see children or grandchildren receive. Give it a timeout, and you can always come back to it, sell it, and walk away. Is this a good break point for George's comment?
Yeah, it is. George's comments is that if he had a holding with negative 20% relative return, he'd replace it because it would be so easy to find a different holding with better prospects. And George, we agree with you. And the problem is that psychology tends to force investors into a position where many investors, in fact, think the exact opposite. That if it's down 20, they're going to get stubborn and hold it till it goes back up 20%, gets back to the market, gets back to where they bought it. And they're not looking at return as any kind of a trigger to sell a stock. They're looking at an SSG, and in fact, many times when a stock's price begins to fall apart, the SSG on the back begins to look even better than it did when you bought it. That's just a function of the mathematics that are involved. Now, the SSG will catch up to the problem as quarter after quarter goes by, but when that price first starts to drop, you get returns that start to go in the other direction. So the returns a lot of times on an SSG actually look better, not worse. So that's an opportunity a lot of times, and Mark said it really well, you know, in for a penny. If it was a good price, if it was a good buy at this price here, well, if it's 20% down, it must be really on sale, and it's even a better price. So we're looking for some actual triggers, but we still want to take into account this idea that, you know, what if the stock falls 20 but the market's down 30? Is that enough of a reason then to sell that stock? Did you in fact have the courage to get completely out of stocks at the bottom of the Great Recession when the time should have been to go back into stocks at the beginning of 2009? So I think it's not quite as black and white a picture as you might want to make it, and I would hope that I could look at a stock that had lost 20% and say it doesn't belong in my portfolio. But I've looked at a number of stocks in my portfolio over the year that have done exactly that and have kept them for all the wrong reasons. We're trying to put some triggers in place. We're trying to put some rules in place that will help us become better investors.
And even beyond that, a lot of times Hugh McManus will talk about a stock that's gone from 90 to 80, and he says, oh, good, I've got an opportunity to accumulate, because those are valid situations also when the conditions are right. That's part of what we'll take a look at here in a minute. So it can make all the sense in the world. So, Ken, why don't you walk us through just some of the thinking on the logic behind what
Well, we've come down to a flow chart, and the flow chart asks us to make some decisions along the way. And so decision number one is the holding period less than 1 year? And if the holding period is less than a year, then we say no, use rule 1 and get out of the stock. But if the holding period is greater than a year, then we're asking, is it a core holding? If the answer is no, then it still might be time to sell even at 16 months or 22 months. If it is a core holding, however, we want to look at the return forecast and the quality. And if we're comparing pretty well to the market, in other words, market down 12, stock down 11, market down 15, stock down 17. If it's comparing fairly well to the market and the quality has not begun to degrade, then we're still going to keep an eye on it. Remember, this is a core holding by the time I'm down to the third box in the flow chart here. But again, if the market's up 2 and the stock is down 23, then the return forecast isn't doing what it's supposed to be, and the quality probably is degrading by that point. Again, we're looking to sell. And if all these things are true, then we're going to look at the industry as well, because a lot of times a good stock is being dragged down by an industry. One of the most vivid examples that I can give of that is the auto parts industry. Being from Michigan, we follow a lot of auto parts companies, a lot of auto companies, and I've over the years I've become a little bit wary of auto parts companies because they tend to fall so much faster than the market when the market's going down, but I forget sometimes that they also tend to rebound. I also forget sometimes when I'm investing in a bad market that good stocks exist in that industry just like in any other industry. Gentex, for example, comes to mind, and during the Great Recession, Gentex did lose some percentage points. It did move in a negative direction as far as earnings are concerned, but it still earned. And compared to its industry, it was doing so much better than almost all of the other auto parts that Gentex to me seemed like a pretty decent buy at the bottom of the Great Recession rather than something that I wanted to get rid of. So we're trying to use this flow chart. We're trying to apply it to real life situations. And the two real life situations that we're going to talk about in this presentation are Under Armour and Starbucks. So Mark, why don't you take a look at Under Armour, okay?
Yeah, and they're both right there. You can see Under Armour was purchased back in January of this year, and they've obviously been beaten up since then, dropping down. In fact, they just had a kind of a step change down to get to that minus 30, so now they'll be on the hot seat at the next roundtable session in September. And then Starbucks, and again, it isn't to the 20% level yet, but it's approaching it. So we would, again, do this, verify and audit, and basically place it on the rule of 5 hot seat as you want to think about it. So again, these are timeout candidates. They've got a holding period less than a year, and we watch for them to be 20% behind the market. Here's a look at a chronicle from Manifest Investing. And what you want to think of this as is these are monthly snapshots of stock selection guides, if you want to think of it that way. The green bars are the price bars, so you can see the haircut that Under Armour received back about 18 months ago, and it's still ebbing, continuing lower. The red line is the return forecast, the projected annual return, much like the number you would see in your section 5 of the stock selection guide. And the blue line up here at the top is the quality. We refer to this as the quality EKG for many companies. And in the case of Under Armour, no, we'll notice that the stock is now down 30% versus the market since we picked it. But this is also a real troubling characteristic. The quality has begun to sag, and that can only mean that, again, think back to the Nicholson and Graham criteria: financial strength, earnings predictability. Obviously, the earnings have been much less predictable. And not only that, the growth and the profitability outlook for the company have suffered relative to its competitors or peers. So, and the financial strength may have actually taken a hit also. That it's actually dropped down one quintile here in the last few weeks, last couple of months. So again, this is something that we really want to attempt to pay attention to. I think this is something we probably have ignored. Is that a fair statement, Ken? More than we should?
Absolutely, Mark. I think that an audit is something that we'll be doing in the roundtable in the next 3 or 4 months, is auditing the quality graphs of the stocks that we own in the roundtable portfolio, looking for situations like this, that the total par value hasn't fallen to a place where it's flashing a red sign at us, but this degradation of quality is probably telling us something about the future prospects of the company.
Yeah, and you can also see in the return forecast has now begun to drift downward while the stock price is drifting downward. That can only mean that the fundamentals are drifting way downward. So whatever's going on at the company, and it could be a speed bump. I'm still of the opinion that this could be a speed bump, but that's the kind of stubborn thinking that often gets me in trouble. So we're trying to find ways to get Mark out of trouble with this stubborn thinking. Okay, the other candidate that's approaching that -20 level is Starbucks. And I think we look at this one a little bit differently. I think we would argue that, yeah, it's in retail. It's, basically a restaurant type company, but it's certainly up straight and parallel. The return forecast, no matter how you look at it, is somewhere in the low teens to mid-teens. Pretty good situation with improving profitability on that graphic at the lower left. Those type of things do seem feasible and achievable, and the PE ratio is moderating somewhere in the low 20s. So again, a growth rate in that 10 or 11% range, an achievable profit margin, and a better PE outlook than it's been for quite some time. It probably says that at least the return characteristic is okay on the company. And the quality is pretty good too. In fact, it's going up. So again, this is the type of situation where, yeah, it's down 15%. I think Hugh would call this an accumulation opportunity based on this picture. The quality EKG is just fine. The return forecast is as high as it's been in several years. And the stock price has been flat for the better part of 2, almost 3 years. So again, we know that companies, Hugh likes to talk, Cy Lynch likes to talk about Home Depot, and Home Depot throughout its history has had these 2 or 3, 4-year periods where the stock price will be flat, and the next thing you know, it's doubling and tripling. We're in the middle of one of those right now. It was flat for several years, and it's gone up rather dramatically in the last year or two. So this type of company can do that, and I think that would impact our thinking on Starbucks, even if it drops down to that -20 threshold.
Yeah, I think the only thing I want to point out on this chart before you move on, Mark, is that when we're talking about degradation of quality, we're talking about moving quintiles. And if you look carefully, the quality ranking is off to the left. It's there's 100 and then 80 and then 60, and those are in percentiles. And there's kind of a light line being drawn across the graph at the different quintiles. So at that one little nudge downward about a year ago, right there, that's not something that I would say is degradation of quality. That's just normal static in a data set that occurs. The same thing with that bump upward about 6 or 7 months ago. But I do like to see that generally in the last 8 or 10 months it has been generally moving in an upward direction again, and now it's higher than it was for a huge long period of time. That's maybe a 3.5 year period where the quality essentially was very stable at somewhere around 96, 97. So I don't want somebody to read this quality line and look at a little tiny bump and say, degradation of quality, and pull the trigger. I don't think that's the kind of trigger we're talking about when it comes to quality, at least. Here's the kind of trigger we're talking about when it comes to quality.
And I think it's worthy of scratching our heads at the next roundtable session over that glitch downward. And between now and then, I think we'll get an update on the company and the industry. So we'll have another data point in here. But yeah, it's definitely enough that I would hold off on accumulating more Under Armour for my IRA under these conditions until I see that quality turn around and restore and stabilize. One of the more powerful lessons I learned as an investor was going from 7 to 49 with ADC telecommunications, only to jump back in at 12 and watch it go down to 12 cents. And basically the time I jumped into ADC was right around here on a quality picture, and the quality proceeded to go straight off like a Mexican cliff dive. So you want to avoid situations where the quality's going the wrong direction. And
I'm laughing, Mark, because ADC Telecom was one of my early big-time failures as an investor as well. It was one of the stocks that was a community favorite right as I was becoming involved with better investing, and I didn't fully understand what I was looking at or what I was doing. I was doing stock selection guides, trying to follow rules that I didn't really understand, and ADC was a poster child for just making a big mess of something. So I can sympathize with you 100%.
That was tough because going from 7 to 49 made me an absolute genius. Going from $12 to 12 cents is just the opposite. I lost everything I gained going from 7 to 49, going the other direction. All right, and again, just to reinforce this notion of what's going on not only with the stock market but in the industry, this is a chart that you can make yourself with big charts. In fact, we noticed they had added an industry comparison button. It'd be interesting to play with that also. But on big charts, you can compare any stock versus its industry. I know this is a little bit hard to see on your screen, but this darker yellow line against the yellow background is actually the restaurant industry. And you can see that in the case of Starbucks, it's down 11% on the date of this report. This was the date that we bought it back, size selection back on May 19th, 2017. And you're basically looking at a little more than 3 months daily chart. You can see that the industry is also down about 9%. So again, this is a situation where we look at Starbucks, we see a company with a kind of an interesting return forecast, no signs of the wheels necessarily coming off, that quality EKG going up, and then this gives us even more ammunition to feel better about these guys are at least keeping up with their industry. And I think everybody here knows that the restaurant industry has been hammered over the last year or so, and it's just one more piece of the puzzle that says, well, maybe there are industry specific things going on at Starbucks that explains some of that minus 14% relative return at this point. All right, Ken, do you want to try to summarize here?
Well, the slide, we've spent a lot of time word crafting some of these slides, and Mark will put a sentence together, and then we'll grab a word out of it and put a word into it. But we think that we've made this pretty clear that we think preserving capital and preserving capital gains are both very important. And we're not changing anything to try to move in that direction, but rather we're looking for triggers. We're looking for something that can help us get even better at maintaining capital, especially during the first year or so of an investment, and avoiding this issue of following a stock up and then following it right back down again too. That really hurts. I still talk to clubs today where they remind me of their Cisco holdings, where they followed it up to plus 100 plus per share, and then followed it down to under $10 and owned it the entire time, sometimes adding to it as it was riding the roller coaster on the downward side. Preserving those capital gains, I think, is just as important as preserving capital. So we're looking at triggers that can help us get rid of both of these from a portfolio. We think it does apply directly to the rule of 5, especially the work that we're looking at with earlier holdings, with 1 year or less holdings, that the numbers are just too nice to be coincidental. We're looking at about 20% of the stocks that we choose in the roundtable or that Mark puts in some of the manifest portfolios, and they misbehave. And they misbehave for no apparent reason. We didn't see it on the stock selection guide. There was nowhere that we could have decided to not buy that stock. There was no a piece of data that we missed. They're just not behaving according to the analysis that was made. We do think that what Manifest does, which is to embed analysts' opinions in our projections going forward, helps us add a percent or 2 or 3 to our rates of return. And we're looking to add another percent or so to our rates of return by developing these triggers. It's a work in progress.
Yeah, I might point out that those numbers are not science fiction. What we did is went back and said, well, what if we hadn't done it? What would the returns be on the portfolios? And again, it's a little bit of rearview mirror. You can try back testing, but again, applying this type of thinking mechanically and saying, well, what if we had caught some of those rule of 5 situations? If we see anything in the neighborhood of 1 to 3%, that is massive over long-term performance. Then the flip side of the question is, well, how many times did we jump out of a company and have it go on to perform admirably in the future? We've only found one case, and I documented in that paper at the bottom, the cover story at the bottom. If not that one, the next one that we came out with just a few months ago, Oracle was the company that actually did quite a nosedive and then came back to have actually fairly stellar performance going forward. So we actually only have one case out of several hundreds. Now, again, keep in mind that the sample size isn't big enough to draw any robust conclusions yet. But when you only have one case where that has happened, whereas a company we jumped out of went on to perform spectacularly, we just think we might be onto something. And again, if we can latch on to that 1 to 3%, that could be pretty powerful for everybody here. And so we're going to keep testing. We're going to keep telling you, how this is going. But we do think that the discipline and the standing best practice procedure that we'll attempt to demonstrate at the roundtable and in other places could be very rewarding for everybody involved. Ken, do you want to take some questions from the audience tonight? We're about an hour in. We said we would try to stick to kind of the roundtable time port.
Right. Let me look at some of the questions we have, Mark, and see. Bonnie again says, what are the return forecasts based on? And again, Mark, a softball for the return coming from Manifest. Why don't you just explain where the Manifest return forecasts are coming from?
Yeah, they're basically coming from the same place that you get them. A stock selection guide. Believe it or not, you are looking at a stock selection guide. It's just in a different format, and it has to do with an income statement. Projecting business conditions 5 years into the future. The column on the left that you see here would align with the August 25th value line. So value line at that time was making a sales growth forecast of 10%, projected net margins of approximately 16, a PE of 24, kicking a little bit of dividend, and we're talking about a 14.9% return forecast for Starbucks at that time, just updating it a few weeks later for a slight increase in the stock price, slightly different assumptions based on input from places like Morningstar, Value Line's obviously in there, Standard & Poor's, Analyst Consensus, a few others. So this is a consensus estimate. The projected net margin is also an algorithm that takes a look at the trend on profitability, kind of like this, but it actually ends up right at that point. A little bit lower PE according to the consensus of analysts. So again, we're talking about 14%. So again, in the same framework, the same analytical method used on the stock selection guide is used to form now those return forecasts. The difference being, again, it's as if we took all the analysts who cover Starbucks, locked them in a padded room, and said, come out with a consensus stock selection guide. That's basically what you're looking at when you see this 14% return forecast.
We have a question from Jaya. Mark, can you go back to the chronicle picture that you showed prior? Jaya, every single stock in Manifest has this graph attached to its page, and that blue line at the top of the graph, that's a graph of quality over approximately a 4.5, 5-year period. So can you extract the graph in Manifest? I'm not sure exactly what you mean, but you can certainly view it in Manifest. That quality graph is there for every single stock in the database for as long as it's been doing business. And if it's been doing business longer than 5 years, then you're seeing at least 4.5, 5 years. Bill Thompson says, would either of us, Mark, consider Under Armour or Starbucks to be core holdings? I have an answer. I'm interested in hearing yours, Mark.
Oh boy. Now I have to try to figure out what the right answer is according to the principal and calculus teacher. I would consider Starbucks to be a core holding based on that picture. And the fact that they had a fairly, a little bit of a challenge. You can see the stock price dipping down in the 2008-2009 Great Recession. Earnings came off a bit while people apparently ordered their coffee without the latte for a while. But yeah, they came through the recession quite well. They've got a longer track record, a very high quality rating. So I would consider Starbucks to be core, even though it's in retail. On the Under Armour, that's a little bit tougher. I mean, I'm literally right in the middle on that one. I'd almost call it a tie because I think they're behaving very much like an early stage company. And in fact, some of the stuff I've written talks about companies like Panera Bread recently. When I picked Zoe's, I pointed out that Panera Bread had some real bumps in the road a few years in. So I think I don't think you can make the same type of picture with Under Armour, so I would probably go on the non-core side of things for Under Armour.
Well, Mark, you've been reading my mind because I would give the same answer, but I would preface it by saying, Bill, that I have an innate bias against restaurants and clothing manufacturers. So I tend not to look very carefully at either of those two industries when I'm putting together a portfolio. I don't own a restaurant. I've owned them over the years and been burned by them on a fairly regular basis. And I don't own any clothing manufacturers for the same basic reason, that they're so hard to evaluate based on the whims of fashion, and fashion plays a terribly integral part into the profitability of the company. So with those biases out there for everybody to see, I would regard Under Armour as a non-core holding and Starbucks as a core holding as well. Diane wants to know, Mark, if you could repeat what the new Big Charts button was.
Yeah, in Big Charts, provided by MarketWatch, so bigcharts.com will actually get you there. It'll take you to the link. If you go to the interactive chart, which is the highest version of the chart, under the compare option for putting things on the graph, the last thing under compare actually imports the industry. The other way to do it is to look up the industry from the Starbucks, from the company page, the Starbucks page in this case, to get that multi-digit industry code for in the case that we displayed, it's actually WSJIX US. Those are always the same. And then the last three digits are RES in order to build that comparison chart. And I think I wasn't actually able to test it because I was on a machine that wasn't being cooperative. but under that highest version of the chart, it looks like you're going to be able to select that industry comparison straight up, and that is something we'll be talking about at Manifest and showing it.
Yeah, and while you're on this slide, Mark, Joan wants to know, is there an easy place to find relative return? Well, Joan, relative return is based on when you buy the stock, and you have to compare it to some type of benchmark. We tend to use the VTSMX. I'll say those letters again, VTSMX, and that's the Vanguard Total Stock Market Index. And what we do is we go to this site that you're seeing a graph of right now. It's called Big Charts, and we start the graph on the day that we buy the stock, and then ask it to compare the stock that we purchased against this index, and then you're able to see what the relative return is off to the side. You can see it visually. You can also get numbers at various times for these prices, and then you can compare the beginning price to the price that it is on the day when you're making the measurement and compare the relative return that way. Mark, could you go to the rule of 5 slide again, do you think?
You bet. There you go.
And Ben, you wanted to know what the rule of 5 was? Well, it's written right here on this slide, and we're getting a number of people asking, where will this presentation be posted? We will be starting a YouTube channel called, I've forgotten the name of the program again, Mark.
You're just not very inspirational.
Yeah, I know. Help me out.
Well, we're going to call it Turnout, at least for now, so it'll probably be
Turnout.
some type of a Turnout folder.
Yeah, so that'll be your keyword for YouTube, and we'll be posting the whole thing there. We don't send out slides, but if you asked really nicely, we might send you a PDF of this particular presentation. The slides just don't go out because they're too easy to mess around with. So we will send a PDF without any problem. A different Diane wants to know, how does the SSG figure in after the stock has been purchased? And Diane, for me, the SSG is a living document, and you have to keep it up to date. You have to keep all the numbers up to date. You have to keep your judgments up to date. But I don't think you have to change them on a regular basis. I think a good solid review of your SSG once a year after the annual numbers come out, I think that's more than enough to deal with your judgments. And I think a healthy look at a quarter that might be doing something really gnarly compared to all the other quarters might force a second review at that point. But I'm watching constantly those return numbers in the bottom, and I'm using Manifest to validate my SSG and to give me some direction. When I find my SSG to be way far away from the numbers that are coming from Manifest, I understand that the Manifest numbers are generated by the analyst community, and I want to know why. If they're telling me 18% return and I'm looking at my SSG and it says 3% return, I want to know why the huge difference. I say validation because I find that my SSGs usually give me a par value within a point or two of the par value coming from Manifest, and that leads me to believe I'm doing a fairly decent analysis then. So the SSG enters into almost everything I do, and then I use Manifest as a tool to verify what's happening on my SSG, to validate it, and I find myself managing my portfolio using the numbers coming from Manifest because I find them to be so close to the numbers that my SSG gives me as well. I'm looking for some more questions here.
I'd just like to make a point that that's an example of a question that can actually evolve into a full session where we take a question like that and explore it deeper. If you have a question or a topic you'd like to see explored, feel free to send to either of us an email at the two shown on the screen, or you respond in the manifest forum with, what would you like to hear about? And we will actually go into individual companies in some cases where we can, build a fairly powerful lesson or that sort of thing. But again, we don't know where this is going. We've talked to Cy Lynch about doing his one of his series on redefining risk. Hugh McManus might show up here at some point to do one of his special presentations. So, the sky's the limit. You guys tell us what you want, what you need, and again, the simplest question can erupt into a great opportunity for discovery. Ann Manning has been asking questions on our forum about companies like Qualcomm. I can't remember the last one she asked about, but again, Enron actually came up. A question can actually launch an opportunity to learn and share, and we encourage that from all of you.
I think one thing, Mark, to put on our list of potential topics, we're getting an awful lot of interest in how to calculate relative return. So I think maybe a practical session on how you actually do it, a hands-on kind of a thing, showing real-time graphs and real data might be of use to a large number of people.
Sure, especially if we're going to base the rule off of it.
Okay, and then Bonnie is back to the moats again. She says, Starbucks sells coffee. Do you think they have a moat? And if so, what is it? And Bonnie, I think they have a moat, and I think it has to do with the number of stores that they already have operational and the brand recognition. I don't know if it's a moat that you would consider to be wide, but I do think that Starbucks has a moat, even though they do a real simple business of just selling coffee. Mark, what do you think about that answer?
Yeah, I don't know how Morningstar defines it. We can actually go look and see what Morningstar has to say. I agree with all that you said there. I mean, they're also very dominant as a provider of coffee to many other people too. So they've got their fingers in the coffee cups in many different ways.
Mark, this is just an aside from Liz, and she wants to know if you could send her some pictures to use in promotional material for the Dallas Educational Day. Mark and I will be in Dallas on the third weekend of October, speaking about investing. If you're anywhere near the Dallas area, I know that the chapter would love to have you. It's in downtown Dallas. You can get more information right off of their website. Since we're plugging things, I'm going to be in Denver on the second weekend in August. If you're anywhere near the Denver area, I'm sorry, I said August. In October, I'm going to be there. And I'd be glad to say hi, and we're certainly going to have an interesting Investors Day in Dallas for the Rocky Mountain chapter as well. Marie wants to know if we've done any thinking about Polaris recently, Mark.
I thought about them while I was watching people on the lake water skiing and having fun with their equipment. I'll leave that answer to you.
I have.
By the way,
I tend.
Well, before you start into that, here's Starbucks, and Starbucks has a wide economic moat according to Morningstar. All right, sorry for the interruption.
I would. My analysis usually is when I leave a stock, I don't tend to go back and agonize over what may have been. I exited Polaris, I don't know, two and a quarter years ago, and I have not taken a real serious look at it until it started to appear on some of my screens again. It has been appearing for the last 4 or 5 months on some of my screens. It's made it back on my list of stocks to study, but it hasn't made it to the top of my list right now. So I don't have anything really new to say about Polaris. I was a great fan of the stock and I made some decent money on it, but they did get themselves into some pretty heavy-duty problems with the quality of their product, especially the paint jobs, and with not being able to supply as much product as they needed when they were selling things. There's been a significant degradation of quality in Polaris. Well, Mark just brought up the Chronicle. You can see the blue line, and there's some significant degradation, but the quality has still stayed above 80. So while it's gone down from the stellar quality that it carried for a long time, it's still in the top quintile. So it's still appearing on my screens that come up. And if it becomes interesting, I'm sure that I'll present it at the roundtable at some point again. Okay. Mark, we're just getting so many questions that we're not going to be able to answer all of them. Okay,
Well,
so I think what we're going to do is we can read these questions again, and we're going to ask some of you to come back. We're getting questions that are quite wide-ranging. They're not focused right on the presentation, so that's good. So. Drop Mark a line, drop me a line if you have a topic for a future turnout session, and we'd love to make these something of a regular thing. Like I said, we're anticipating somewhere maybe 7, 8 a year, and if you have something you'd like us to talk about, ask us, and we're pretty creative. We can probably find a way to pull together a presentation on it in the future. We'd like to thank you all for coming to the premiere session of Turnout Tuesday. We're going to try to keep these on Tuesday. We're going to try to keep them somewhere near the beginning of the month, so as not to really, step on the roundtable too much. This one was 2 weeks after the roundtable, so maybe the second Tuesday in October, but we'll certainly be letting you know through the same channel that you get your reminders from for the roundtable. Natalie will be glad to send those out to anybody that would like to be added to the list. So if you're not on the reminder list, just send me an email, and we'll be glad to add you to that list. My email address is kkavula1@comcast.net. And you can also send emails to Mark at mark@manifestinvesting.com. And here are the email addresses right on the home page right here. Again, give us a couple of days to get this up onto YouTube. Remember that I'm a non-paid volunteer, and there's a lot of days that go by that Mark is a non-paid volunteer as well. So give us some time to get it up on YouTube, but we certainly will try to do that. And drop an individual email if you'd like a PDF of the presentation, and we'll try to send that out to you in the next week or so then. Mark, again, on behalf of my chapter, thank you so much for agreeing to put together this program. I think that these kind of discussions serve our community very well. And shall I tell them that we have an email from somebody that we're going to use as the basis for our next turnout?
Well, we're certainly thinking about it. It's a club that went through and asked a lot of questions that a lot of you would echo, and it has to comes down to best practices for being a successful investor, either as an individual or as a club. So I think it's a fair game. At some point in the next few weeks, we will have a session where we talk about best practices in some of these disciplines that George has to us.
Thank you all for being here, and we'll hope to get together again in the next 3 or 4 weeks. Thanks a lot, folks.
Thanks, everybody.